and welcome. You're watching The Money Show, your one-stop destination for all your personal finance queries. And I'm Kavita Thapliyal. And today, again, we're going to be talking about portfolio strategies for your investments and how can you align your financial goals looking at the volatility in the market. And when we talk about volatility, there's a new category which has gained a lot of interest among investors, which is low volatility funds. So today we'll be deep diving into this particular category and looking at the current scenario. How is it for you to consider investing in these kind of funds? We'll understand all aspects on this, and we will also throw up on the counter to get your mutual fund portfolio queries answered. So just in case you're watching the show live, you can send across your question on our WhatsApp number and our email ID. All right, so let's begin the show. And today I have with me Shweta Rajani from Anand Rathi Wealth. Shweta, hi, good evening and welcome to the show. So, Shweta, low volatility funds, you know, we've been hearing about these kind of funds since some time now, and it has also gained a lot of investor interest and investor momentum. Now, while long-term returns, you know, will obviously be aligned with your expectations, provided you invest in a disciplined manner in the equity market, but the short-term fluctuations do impact your fund's performance. It is not separated from that. Now, when we talk about low volatility funds, how are we talking about mitigating risk? Because one is the risk factor and one is the reward factor. You know, people say that if you are invested in these kind of crucial times or challenging times in the market, you will definitely be rewarded with a better return. But what if one doesn't want to ride out this volatility and maybe just wants to secure the kind of gains that they have made in their portfolio in last few years? How do you look at low volatility funds in these challenging times, Shweta?
Good evening, Kavita. Like you said, you know, right now, while we are in this phase where there is excessive volatility in the market, strategies or how do you really manage risk of your portfolio becomes something which is on top of the mind of every investor. So one way to mitigate this volatility, of course, is that stagger your investments, because if you stagger your investments, you get the benefit of rupee cost averaging. The other one is simply hold on to your investments for a longer tenor, because as the investment horizon goes on increasing, the volatility goes on reducing. But yes, that generally would not happen with investors, because we are used to looking at our portfolios on a 15-day, 1-month basis. So having strategies which can bring down the volatility of the overall portfolio therefore needs to be considered. Now, when we talk about reducing the volatility and then you hear of a category which itself is low volatility, it would raise antennas for all investors. But let me really tell you what this category is. Now, as the name goes, what it does is it will look at a broader stock universe, let's say a Nifty 100 or a Nifty 500, and from that it ranks companies in the ascending order of volatility. How is volatility really measured for them? They look at the standard deviation of the daily returns for the last 6 months. And whichever stock has had a lower standard deviation, that would ideally feature among the top constituents of the portfolio. Of course, there are other variables as well, like they would want the company to be in the F&O segment, have a high trading volume. So those are other aspects. But the main definition is you have to be low in terms of your standard deviation. Another simple term for standard deviation is the variation that you would see in your returns on a daily basis. So that's how these indexes are created. The first index, to give you a little background of this, the first index, which was the low volatility 50 index, was constructed in 2012. But more number of indices started coming in this segment from 2015, 2017 onwards. If I have to look at funds being available to invest in this kind of category, the first fund I think came in 2020. So you had 2 schemes in 2020, but as we speak, we have around 17 funds in this category today.
So, Shweta, definitely, you know, the low volatility index has outperformed Nifty 50 TRI approximately 60% of the time in last few months, if I have to talk about, or specifically talking about last year. It exhibits resilience during the market downturns. There's no doubt about it. But when we are talking about a market cycle over here, what should be the timing to invest in these kind of funds? You explain how these funds work and the parameters that they work on, but from an investor's point of view, what should be my timing to enter in these kind of funds? Should I be already having these funds in my portfolio, or now, looking at the volatility in the market, I should be putting in money over there?
So, Kavita, if we actually look at the indicators of these index, yes, if you see in periods of excessive volatility, these strategies may outperform a Nifty 50 index, or if I'm talking about let's say Nifty 100 low volatility 30, that may outperform Nifty 100, which is the mother index, as I would call it, in brief periods. But one thing is that they've not gone through an entire cycle to see how they would perform across cycles. Second, if I just break up, from 2020 onwards, because that's when the first index fund came in, if I compare this to an actively managed fund, because what is your option? Either you buy a low volatility index fund, or you assign your money to a fund manager who's also actively managing and is responsible for managing risk as well as delivering returns for you. If I look at that, then in 4 out of 5 years, an actively managed fund would have beaten a low volatility index fund in terms of return. Talking about risk, even if I compare risk and I'm referring to standard deviation as a number, if I am looking at the 1 year average standard deviation of a low volatility index, it's been around 10%. Now, 10%, if I compare this to a Nifty 50, it's been at around 8.5. So honestly, when you look at these data points, it says that you're not really bringing down the risk by investing in a low volatility fund, but you are somewhere compromising on the return. So if I have to compute what we call as a Sharpe ratio or an efficiency ratio, which is for every 1 unit of risk taken, how much return would I have made as an investor? Maybe being in an actively managed fund would be more efficient for you than being in a low volatility fund. So that's where I would suggest you to manage volatility of the portfolio by creating a basket of actively managed funds of different styles, of different market caps, and bring down the volatility rather than having a low volatility fund. Another drawback of the low volatility fund would also be that it's not, the index is rigid once every 6 months. So if in the interim there is any stock where the volatility is increased, the index would not take it out. So you would be compromising somewhere on the portfolio there.
All right. So now looking at the strategies, Shweta, let's just focus on that. It's clearly a passive strategy that one can opt for. But here, do we have like a complete index play, or there is a mix of strategies even within that category?
Yes, so there are mixed strategies as well. So you could have something which is a pure low volatility index, and you could have something which is, let's say, an alpha plus low volatility index. Uh, but if I look at the 17 odd funds which are available today, most of them are following just the low volatility index. Almost 60% of the AUM, which is there in the volatility plus alpha plus low volatility strategy, that comes in one index fund, which is your Nifty 100 low volatility 30 stock index. So yeah, there are hybrids where the index created is a combination of stocks which would have delivered a certain alpha and have a low volatility. So it's a hybrid or a multi-factor score that is used to create those indices.
Since you also highlighted the drawbacks, I also want to understand the risk factors. Now, considering these are low volatility funds we are talking about, it's a passive strategy that we are talking about, but doesn't mean they are not risky at all, or they are risk averse strategies. There are certain amount of risk involved, and what would that risk be?
Absolutely. See, one is you're participating in equity. So, even if it is a low standard deviation stock or a low beta stock, there is some amount of risk which is there. Second, most of these indexes which are created in the low volatility would have certain concentration risk because these are either 30 stock or 50 stock indices. Third, like I said, the rejig that takes place, the rebalancing of the index happens once in 6 months. So for 6 months, you're not actively managing that portfolio. So if anything is going wrong with a particular company, it's not being moved out of the index. Fourth, the other drawback of the index is that there'll be limited changes that would be made. So, let's say out of 30 stocks, you want to ideally replace 10 stocks. That's not possible in the index because there is a limit on how many stocks would you change. So this is where I said, if you are moving into a active strategy, which can have stocks which are low in terms of volatility, which have high earnings growth, and therefore can give you a high alpha, may actually turn out a better option for you than going in for a passively managed index.
Sure. Shweta, can I also ask you about the historical performance if I want to compare it to Nifty 100? Is that the right comparison to do? And, if you can just go back in time and tell me how has the performance been?
Absolutely. So, if you're comparing it to Nifty 100, I'll also look at the Nifty 100 Low Volatility 30 Index. Here, if I see over a 5-year period, the index would have given around 12% return as compared to 11.7, which the mother index would have delivered. For the same time period, if I have to look at what an actively managed fund that would have delivered, that would be around the 14-15%. Last 1 year, if I see the strategy, the low volatility fund would have delivered 11% as compared to 11.8 of the mother index. So it's more or less at par with the main index.
Sure. Now let's look at strategizing this in a portfolio. Earlier in your answers, you highlighted that one needs to have a very solid active strategy, and maybe one can have this kind of a flavor also as far as, giving stability to your portfolio is concerned. Now, what type of funds, and because you just mentioned there are 17, 18 funds, if I'm not wrong, that's what you said earlier. How do you choose which is the right one for you? Because there are so many mixed strategies that we discussed, and we're also looking at the returns, which is something that one can really look at and appreciate, especially in the volatile period right now. What should be your selection like, and how should you decide on your low volatility fund?
If we are, referring to specifically the low volatility index funds or passive as a strategy for your portfolio, what you should do is within the low volatility category, like I said, you have around 4 to 5 indexes which are pure low volatility index, and you have another 3, 4 which are a combination of alpha and low volatility. So even here, don't go in for a pure low volatility. Have a combination of both of these. Check for which fund has a lower expense ratio. That becomes critical because lower expense ratio means your returns can slightly improve. Go in for funds where there is a lower exit load on the portfolio. So those would be few factors that you should consider even when you are choosing which passive strategy you should go in for, and diversify even across your passive strategy.
I think that will be all as far as discussion on the low volatility fund is concerned, and it's time for a quick break. But I do have Shweta with me connected, and post that we'll be answering our viewer queries. But just before I hit the break, I'm going to flash our WhatsApp number and email ID just in case you want to send across any question while watching the show. You can do that.